The long upper shadow is a bearish signal in trading that is characterized by a candlestick with a long upper wick. This pattern indicates that while the price during the session moved higher, it closed near the open, suggesting that sellers were able to push the price back down. It reflects uncertainty or rejection of higher prices by the market and can signal a potential reversal or a pause in the upward momentum. Identifying and interpreting the long upper shadow within your trading activities involves looking for candlesticks with significantly long upper wicks compared to their bodies. This pattern usually occurs at the end of an uptrend or during a pullback within a larger downtrend. It is important to consider the context in which this pattern appears, as its significance can vary based on preceding price movements and market conditions. We encourage traders to practice spotting this pattern and integrating its interpretation into their decision-making process. Learning to recognize the signals it offers can enhance your ability to make informed trading decisions, but it is just one tool among many in the complex field of technical analysis. In conclusion, understanding the long upper shadow and its implications is a valuable skill in trading. However, it should be part of a larger strategy that involves continuous learning and adaptability. The dynamic nature of the financial markets requires that traders remain open to new information and flexible in their approaches. By staying educated and responsive to market conditions, traders can better navigate the challenges and opportunities that arise. Candlestick patterns are a form of technical analysis used by traders and investors to predict future market movements and sentiments based on past price actions. Originating from Japan over 200 years ago, these patterns are now a staple in financial markets around the world. They offer a visual representation of the price movements within a specific time frame, capturing the open, high, low, and close prices. The patterns are particularly valued for their ability to condense market information into easily understandable formats, helping market participants make informed decisions. Among the various patterns, the Basic Dual Candlestick Patterns stand out for their analytical value. These patterns comprise 2 candles and can offer insights into market sentiment and potential price movement directions. They serve as a crucial tool in technical analysis, enabling traders to interpret bullish or bearish signals. Examples include the bullish engulfing pattern, which may indicate a reversal from a downtrend to an uptrend, and the bearish engulfing pattern, which might signal a shift from an uptrend to a downtrend. Understanding basic dual candlestick patterns equips traders with the ability to gauge the strength of market trends, identify reversal opportunities, and ultimately make more strategic trading decisions. Given their significance, these patterns are essential for anyone looking to delve deeper into market analysis and improve their trading acumen. Basic dual candlestick patterns are specific formations on a candlestick chart that signal potential future price movements in the market. These patterns are essential for traders to understand as they provide insights into market sentiment and possible reversals or continuations in price trends. Here is a description of some fundamental dual candlestick patterns such as bullish and bearish engulfing, Tweezer tops and bottoms, and the Harami patterns. Bullish engulfing pattern occurs at the end of a downtrend. The formation comprises 2 candles where the second candle completely engulfs the body of the first candle, indicating potential buying pressure and a reversal towards an uptrend. Imagine a smaller red or black candle followed by a larger green or white candle that wraps around the red one. Bearish engulfing pattern is the opposite of the bullish engulfing and appears at the end of an uptrend. The pattern has a smaller green candle followed by a larger red candle which engulfs the body of the first candle, signaling selling pressure and a probable downtrend reversal. Picture a green candle being fully enveloped by a subsequent larger red candle. Tweezer tops and tweezer bottoms are two dual patterns that signal reversals. Tweezer tops occur at the peak of an uptrend when two consecutive candlesticks have matching highs, indicating a potential reversal to the downside. Conversely, tweezer bottoms appear at the bottom of a downtrend where two candles have identical lows, suggesting a reversal to the upside. Imagine two candlesticks standing side by side, their tops or bottoms aligning perfectly like the tips of a tweezer. The Harami pattern, also known as the pregnant pattern, indicates a potential reversal and is identified by a smaller candle that is completely contained within the range of the previous larger candle. A bullish Harami occurs in a downtrend and consists of a large red candle followed by a smaller green candle, hinting at a possible upward reversal. A bearish Harami, on the other hand, appears in an uptrend and consists of a large green candle followed by a smaller red candle, suggesting a potential downward reversal. Picture a small candle nestled inside the body of a larger one, resembling a pregnancy. While visual aids and chart examples would greatly enhance the understanding of these patterns, imagine these descriptions creating a vivid picture of the formations within the price movements of a market. These basic dual candlestick patterns are crucial for traders who rely on technical analysis to predict future market movements based on past price actions. Identifying basic dual candlestick patterns relies on observing specific features which include the shape, size, color of the candles, and their positioning within a trend. Let us explore these identifying characteristics. 1. Shape and size. The shape of the candlesticks can give clues about market sentiment. For instance, a pattern with a long body indicates strong buying or selling pressure, whereas a candle with a small body suggests indecision or consolidation in the market. A candle with a small body and long wicks, known as a doji, signals indecision among traders. 2. Color of the candles. The color is also pivotal. Typically, a green or white candle represents a closing price higher than the opening price, indicating buying pressure. Conversely, a red or black candle signifies a closing price lower than the opening, indicating selling pressure. 3. Position in a trend. The placement of the candlestick pattern within the trend is crucial for interpretation. For example, a bullish engulfing pattern consisting of a small red candle followed by a larger green candle that completely engulfs the red candle suggests a potential reversal in a downtrend. On the other hand, a bearish engulfing pattern where a small green candle is followed by a larger red candle may indicate a reversal in an uptrend. Let us examine two instances to illustrate these patterns in various market conditions. Bullish engulfing pattern. Imagine observing a downward trend on a chart and then this pattern emerges. The first candle is red, small, showing the continuation of the selling pressure. The next day, a large green candle appears that completely covers the red candle. This pattern suggests that the buyers are gaining control and a possible uptrend might follow. Bearish engulfing pattern. In contrast, during an uptrend, you notice a small green candle, followed by a large red candle that entirely engulfs the green one. This pattern indicates that sellers have overcome the buyers and a downtrend could be imminent. In both examples, traders utilize these cues, the candle's colors, sizes, and their position within the trend to make predictions about future market movements. Understanding these basic dual candlestick patterns can provide valuable insights into market sentiment and assist in making informed investment decisions. Basic dual candlestick patterns in financial markets are visual indicators that highlight the sentiment of traders and the ongoing battle between buyers and sellers. These patterns are formed by two adjacent candlesticks on a chart and can signal shifts in market dynamics from bullish to bearish sentiments or vice versa. Understanding these patterns is crucial for interpreting the attitudes and emotions of traders. One common pattern is the bullish engulfing, where a smaller red candlestick representing a day of losses is followed by a larger green candlestick indicating strong buying pressure and a potential upward trend. This pattern suggests that, despite initial bearish sentiment, buyers have taken control, reflecting a shift in market sentiment from bearish to bullish. Conversely, the bearish engulfing pattern, where a small green candlestick is followed by a larger red one, signals that sellers have overwhelmed buyers, moving the market from bullish to bearish sentiment. This change indicates that the confidence among buyers is waning, and a downward trend may be forthcoming. The Harami pattern, whether bullish or bearish, signifies a potential reversal or pause in the current trend. A bullish Harami, for example, forms when a large red candle is followed by a smaller green candle, hinting at a slowing down of the bearish momentum and a possible upward reversal. The smaller the second candle, the higher the chance of a turnaround. Finally, the piercing line and dark cloud cover patterns signal a change in market dynamics. The piercing line, indicative of a switch from bearish to bullish sentiment, forms when a long red candlestick is followed by a green one that opens lower but closes above the midpoint of the previous day's body. The dark cloud cover, signaling the opposite shift, occurs when a green candlestick is followed by a red one that opens higher but closes below the midpoint of the preceding candle's body. Each dual candlestick pattern reflects the underlying emotional state of the market participants. By accurately reading these patterns, traders and investors can gain insights into future market movements and adjust their strategies accordingly, navigating the markets with a more informed perspective. Basic dual candlestick patterns in the context of financial markets can either signal a potential reversal or indicate trend continuation, depending on their formation and the preceding market conditions. These patterns consist of two candlesticks and are a fundamental aspect of technical analysis, helping traders to decipher market sentiment and predict future movements. One notable reversal pattern is the bearish engulfing, which appears at the end of an uptrend. Picture a long green candle followed by a longer red candle that completely engulfs the body of the green candle. This scenario suggests that sellers have overwhelmed the buyers, potentially leading to a trend reversal to the downside. Conversely, the bullish engulfing pattern signals a potential reversal from a downtrend to an uptrend. It features a long red candle followed by a longer green candle. The green candle's body completely engulfs the red candle's body, indicating that buyers are taking control from sellers. A pattern often indicative of trend continuation is the Harami. The Harami consists of a long candle followed by a smaller candle whose body is located within the vertical range of the larger candle's body. If this pattern forms during an uptrend, it is termed a bullish Harami and suggests continuation of the uptrend. During a downtrend, a bearish Harami can form, hinting at the continuation of the downtrend. Context is crucial for interpreting these patterns accurately. For instance, a bullish engulfing pattern is more significant if it forms after a pronounced downtrend and at a support level. Similarly, a bearish engulfing pattern gains relevance when it appears after an extended uptrend and near resistance levels. Charts illustrating these patterns can show varying outcomes. For example, a bearish engulfing pattern that forms without significant prior uptrend and not near major resistance may not lead to a significant downturn. Similarly, a bullish Harami pattern occurring in a stagnant or sideways market might not signify a strong uptrend immediately. Therefore, while basic dual candlestick patterns provide valuable insights, their interpretation should always consider the broader market context, including trend strength, support and resistance levels, and market sentiment. This holistic approach ensures a more accurate and nuanced understanding of potential market movements. To validate the implications of basic dual candlestick patterns, additional indicators or conditions such as trading volume, nearby support and resistance levels, and the trend preceding the pattern can be considered. These factors can play a crucial role in strengthening or weakening the reliability of these patterns. Trading volume is a key indicator that can help confirm the validity of a candlestick pattern. An increase in volume during the formation of a pattern suggests a stronger conviction among traders about the impending market movement, thereby enhancing the reliability of the pattern. For instance, a strong buying signal is more credible when accompanied by a substantial increase in volume. Support and resistance levels are price points where a trend is likely to pause or reverse. These levels are determined by the past performance of the stock at these price points. When a candlestick pattern forms near these levels, the implications of the pattern become more significant. If a bullish reversal pattern forms near a support level, it might indicate a strong buying opportunity. Conversely, a bearish reversal pattern near a resistance level could suggest a good selling point. The trend preceding the pattern is also critical. Candlestick patterns do not exist in isolation. They are more meaningful when considered in the context of the preceding price movements. A pattern that occurs within an ongoing trend can be seen as a continuation signal, while a pattern that forms against the current trend may signal a potential reversal. Understanding these additional indicators and conditions requires careful observation and analysis. When combined with basic dual candlestick patterns, they provide a more comprehensive view of market sentiment, allowing traders to make more informed decisions. However, it is important to remember that no single indicator or pattern can guarantee future price movements. As such, incorporating multiple sources of information and maintaining a balanced perspective on risk management is essential to successful trading. The historical accuracy of basic dual candlestick patterns in predicting market direction changes has been a topic of study and application among traders and analysts for decades. These patterns, formed by just two candlesticks, convey significant information about market sentiment and potential reversals in trend. Fundamental patterns such as the engulfing pattern tweezers, and the dark cloud cover have demonstrated a noteworthy ability to forecast short-term market movements. However, while these patterns are valuable tools, their predictive power is not absolute. The reliability of basic dual candlestick patterns varies across different markets and time frames. Moreover, their interpretation can be subjective depending on the observer's experience and the contextual market conditions. Recognizing these limitations underscores the necessity of a comprehensive analysis using multiple indicators. Relying solely on candlestick patterns for decision-making could lead to missed signals or misinterpretations. Therefore, traders often integrate other technical indicators like moving averages, relative strength index, or volume metrics to confirm the signals suggested by candlestick patterns. Incorporating a multifaceted approach enhances the robustness of the analysis, combining the nuanced insights candlestick patterns offer with the broader market perspective other tools provide. This blend not only ameliorates the limitations inherent in using candlestick patterns in isolation, but also aligns with a prudent trading strategy that values risk management and predictive accuracy. To integrate basic dual candlestick patterns with other technical analysis tools like the Relative Strength Index, RSI, Moving Average Convergence Divergence, MACD, or Bollinger Bands, one can follow a multifaceted approach to enhance precision and reliability in trading decision-making. One method involves using the RSI in conjunction with dual candlestick patterns to gauge the market's momentum and identify potential reversals. For example, if a bullish engulfing pattern emerges while the RSI is below 30, it signals an oversold condition alongside a potential upward trend reversal, suggesting a buying opportunity. Similarly, the MACD can be paired with dual candlestick patterns to pinpoint entry and exit points. When a bearish Harami pattern coincides with a MACD crossover from above to below the signal line, it indicates a possible start of a downtrend, signaling a selling or short selling opportunity. Incorporating Bollinger Bands with dual candlestick patterns can also provide insights into market volatility and price levels. A scenario where a bullish engulfing pattern forms near the lower Bollinger Band suggests that the prices might be at a low point with a potential for an upward reversal, presenting a favorable buying condition. When applied in real-world trading, integrating these technical analysis tools with dual candlestick patterns enhances decision-making by providing a more holistic view of market conditions. For instance, a trader might identify a bullish engulfing pattern indicating a potential upward trend. By confirming this pattern with an RSI indicating an oversold condition and a MACD showing a bullish crossover, the trader gains confidence in the potential for an upward movement, making a well-informed decision to enter a buying position. This multi-tool approach not only helps in confirming the strength of the signal provided by the candlestick patterns, but also in minimizing risks by ensuring that multiple indicators align, thus enhancing the probability of successful trades. Common errors and misconceptions regarding basic dual candlestick patterns often stem from an over-reliance on these patterns without considering the broader market context. One of the most frequent mistakes is attributing too much significance to these patterns in isolation. Traders might see a dual pattern forming and assume a market reversal or continuation is imminent, ignoring other critical factors such as volume, market trends, or economic indicators. This can lead to premature or misinformed trading decisions. Another common mistake is mistaking similar looking patterns for one another without noting the nuances that differentiate them. For example, a trader might confuse a bullish engulfing pattern with a piercing line pattern because they did not notice the difference in the second candle's opening and closing prices relative to the first candle. Such oversights can significantly impact the interpretation of market sentiment and subsequent trading actions. To avoid these pitfalls and enhance pattern recognition and analysis skills, traders are advised to follow a few key tips. First, always contextualize candlestick patterns within the broader market picture. This means considering other technical indicators, analyzing the current trend, and factoring in relevant news or economic events. Combining these insights will provide a more accurate and reliable basis for interpreting candlestick patterns. Second, education is crucial. Traders should invest time in learning not just the basics of individual patterns, but also the subtleties that distinguish one pattern from another. There are many resources available, from books and online courses to trading forums and webinars, that can deepen understanding and sharpen analytical skills. Lastly, practice makes perfect. Utilizing demo trading accounts or backtesting strategies on past market data can be invaluable for building confidence in identifying and interpreting candlestick patterns. Over time, this practice will refine a trader's ability to spot genuine opportunities and avoid common misinterpretations that can lead to losses. Employing basic dual candlestick patterns in setting entry and exit points for trades involves recognizing these patterns and understanding the market sentiment they indicate. These patterns, such as the bullish engulfing or bearish engulfing, are formed by two consecutive candlesticks and can signal potential reversals in the market, making them valuable for traders seeking to time their entries and exits. For entry points, a trader might look for a bullish engulfing pattern, which occurs when a small bearish candlestick is followed by a larger bullish candlestick that completely engulfs the first one. This pattern suggests that buying pressure has overcome selling pressure, possibly indicating a reversal of a downtrend. Thus, a trader might consider entering a long position following the confirmation of this pattern. Conversely, for exit points or entering short positions, a trader could utilize the bearish engulfing pattern. This pattern appears when a small bullish candlestick is immediately followed by a larger bearish candlestick that engulfs the first one, signaling that sellers are outweighing buyers. It may suggest a bearish reversal is imminent, prompting a trader to exit long positions or enter a short position. One case study involves a trader who closely monitored the stock of a technology company, looking for signs to enter the market. Upon noticing a bullish engulfing pattern at a support level following a significant downtrend, the trader decided it was an opportune moment to enter a long position. The reversal indication was correct, and the stock price began to rise, offering a profitable exit point a few days later, right before a bearish engulfing pattern emerged, signaling a potential reversal of the uptrend. 5 key elements to success with this strategy include observing volume as a confirmation, waiting for pattern confirmation, considering the broader market context, setting stop-loss orders to manage risk, and maintaining discipline to adhere to predetermined exit points. This approach allows traders to capitalize on short-term price movements based on shifts in market sentiment, as indicated by these basic dual candlestick patterns. In the realm of technical analysis, understanding basic dual candlestick patterns is essential for traders. These patterns consist of two candlesticks that convey significant insights into market sentiment and potential price movements. Let's delve into the variations of these patterns and their unique implications in trading alongside chart examples. One common pattern is the bullish engulfing. It occurs when a smaller red candle, signifying a price decrease, is followed by a larger green candle, indicating a significant price increase, essentially engulfing the red candle. This pattern suggests a shift in market sentiment from bearish to bullish, signaling potential buying opportunities. Conversely, the bearish engulfing pattern is observed when a green candle is followed by a larger red candle, engulfing the former. This signifies a shift from bullish to bearish sentiment, hinting at potential selling or shorting opportunities. Another variation is the Harami, which is the opposite of engulfing patterns. A bullish Harami consists of a large red candle followed by a smaller green candle contained within the body of the previous day's candle. This suggests a slowing down of the bearish trend and a possible reversal to bullish momentum. Similarly, a bearish Harami includes a large green candle followed by a smaller red candle, indicating a potential pause or reversal of the bullish trend. The piercing line and dark cloud cover are variations that include a 2-day reversal pattern. In a piercing line, a long red candle is followed by a long green candle that opens lower but closes at least halfway into the body of the red candle, suggesting a bullish reversal. The dark cloud cover is its bearish counterpart, where a green candle is followed by a red one that opens higher but closes within the body of the previous candle, indicating a bearish reversal. To interpret these variations effectively, imagine chart scenarios where these patterns emerge during a trading session. For instance, spotting a bullish engulfing pattern at a key support level could suggest an opportune moment to enter a long position, anticipating an upward price movement. Similarly, a bearish engulfing pattern at a resistance level might warn of an impending downtrend, advising caution or a potential short position. Remember, while these patterns provide valuable signals, integrating them with other technical indicators and fundamental analysis will enhance the accuracy of trading strategies.